Have you noticed something surprising lately? Over the past few months, both gold and silver prices have been falling. At first glance, that doesn't seem to make sense. The world still feels unstable. There are ongoing geopolitical conflicts, persistent inflation concerns, and plenty of economic uncertainty. Isn't gold supposed to be the ultimate safe haven asset? So why has its price been dropping instead? In today's video, we'll break down why gold and silver have been falling recently and whether precious metals were still good long-term investments. Why have gold and silver always been valuable? Before we dissect the why, we need to understand the fundamental mechanics. For thousands of years, gold has served as money, a symbol of wealth, and a reliable store of value. Even today, central banks around the world continue to hold large amounts of gold as part of their official reserves. Silver is a little different. Besides being an investment asset, it is widely used in electronics, solar panels, medical equipment, and many other industrial applications. In other words, gold is driven primarily by investment demand and safe haven buying, while silver is influenced by both investment demand and industrial demand. Why have gold prices been falling? In the short term, here are the 4 main reasons behind the recent drop in gold prices. 1. Higher oil prices cause inflation, and the market expects U.S. interest rates to rise. Conflicts in the Middle East fueled a surge in oil prices, and higher oil prices raise concerns about inflation. Traditionally, inflation expectations tend to make gold appealing. However, recently, rising inflation has led investors to anticipate interest rate hikes by the Federal Reserve. Unlike bonds or savings accounts, gold doesn't generate any interest. When investors expect interest rates to go higher, income-producing assets like bonds become much more attractive. As a result, money tends to flow out of gold and into fixed income investments. As long as markets believe the Fed isn't ready to cut rates, higher interest rates generally put downward pressure on gold prices. 2. Profit-taking after a huge rally. After a strong rally, investors start taking profits. Gold reached record highs in January 2026, prompting many large institutional investors, hedge funds, and even some central banks to lock in gains. For example, Turkey's central bank significantly reduced its gold holdings during the first quarter of 2026. One reason was to raise cash, as higher energy prices increased Turkey's import costs. When large institutions begin selling substantial amounts of gold, prices often experience a short-term correction. 3. A stronger U.S. dollar. The third reason is a stronger U.S. dollar. Gold is often viewed as an alternative form of money. Historically, gold and the U.S. dollar have moved in opposite directions. When the dollar strengthens, each dollar has greater purchasing power, making dollar-denominated assets more attractive. That naturally reduces the appeal of holding gold. 4. Safe haven demand has cooled. Many people ask, if there are still wars happening, why isn't gold soaring? The answer is that markets don't simply react to whether a conflict exists. They react to whether the situation is getting significantly worse. Although tensions in the Middle East and the war in Ukraine remain elevated, investors generally believe that the conflicts are still largely contained within specific regions. Global financial markets continue to function normally, and stock markets have remained relatively strong. As investors regain confidence, some money flows back into stocks and other risk assets, reducing the demand for gold as a safe haven. Does that mean gold is no longer a good investment in the long run? Not necessarily. If we zoom out and look at the bigger picture, the long-term drivers supporting gold remain largely unchanged. 1. Inflation persists. Conflicts in the Middle East have pushed up oil prices. At the same time, the U.S. government's ongoing fiscal expansion and massive public spending continue to pump capital into infrastructure and various subsidies, providing market demand. Furthermore, as corporations reshore their production lines, manufacturing costs have escalated significantly. Together, these factors have kept inflation stubbornly high. Over time, inflation gradually erodes the purchasing power of fiat currencies. Gold has historically been viewed as one of the most effective assets for preserving purchasing power over the long run. 2. Central banks are still buying gold. According to the latest data from the World Gold Council, central banks in countries such as Poland, China, Uzbekistan, Kazakhstan, Singapore, India, and the Czech Republic continue to increase their gold reserves. This suggests that official demand for gold remains strong. 3. Geopolitical risks haven't disappeared. The Middle East conflicts remain. On top of that, we have the lingering war in Ukraine and the intense rivalry between the U.S. and China, which is driving the ongoing restructuring of global supply chains. All of this combined means that economic uncertainty is going to remain high. Gold continues to serve as an asset that isn't backed by any single government or currency. it remains a reliable safe haven asset. The biggest mistake investors make with gold and silver. Now let's talk about the biggest mistake investors make with gold and silver. They treat them like get-rich-quick trades. When people see headlines saying gold is hitting new highs, they rush in emotionally. They imagine gold will only go up. They buy too much, too late, and without a plan. But precious metals can be boring for long periods. They can disappoint investors who expect fast profits. The smarter way to think about gold and silver is not as lottery tickets, but as potential portfolio tools. So how much gold or silver should someone own? There is no universal answer. It depends on your risk tolerance, your financial goals, your time horizon, and your view of the economy. Some investors hold no precious metals at all. Some hold a small allocation, like 5% or 10% of their portfolio. Others hold more because they are deeply concerned about inflation, currency risk, or financial instability. The key is this: know why you own them. If you own gold because you want diversification and protection, and if you own silver because you understand its volatility and industrial demand, that is very different from buying them just because someone online said they will go to the moon. The best investors do not worship gold. They do not ignore it either. They understand what it is. Final thoughts. Why has gold been falling recently? Mostly because of short-term market forces, expectations of higher interest rates, a stronger US dollar, and profit-taking after a historic rally. But over the long term, the fundamental drivers haven't changed. Rising government debt, continued central bank purchases, and persistent geopolitical uncertainty all continue to support the long-term investment case for gold. If you're a long-term investor, gold can still play an important role in a diversified portfolio. Just remember that gold is best viewed as a tool for diversification and wealth preservation, not as a way to get rich quickly. After watching today's video, what's your take on gold and silver? Do you view gold as an investment or insurance? Drop your thoughts below. If you found this video helpful, don't forget to hit the like button, subscribe to the channel, and turn on notifications. I'll see you in the next video.